Hi, this is Professor Hazera, and I'm going to have two short videos on estimating inventory. Now, these are traditionally in intermediate accounting texts, and they tell you that you should estimate inventory when your inventory records burn or whatever. But it's important for more than anything for financial statement analysis to be able to work backwards through accounts and estimate cash flows and inventories. So I think in a modern context, the book should be saying not that a company's records are burned down, so they got to go back and recreate their records through estimation, but these are just basic methods of financial statement analysis. Okay, now there are two ways of estimating inventory, and the second way has a lot of variations. All these things have a lot of variations, so I'm just going to cover the fundamentals of each way. And if you understand the logic of something, then you can certainly understand the um, the any modifications to that methodology. Okay, so there's two ways. There's really more than two ways, but basically common sense, that we call it, and a knowledge of financial statements. But anyway, so there's two basic methods for estimating inventory. These are the gross profit method. These are gross profit method and the retail method. And both methods are based on your knowledge of the basic cost of goods sold equation, which is what I went through in the first basic video on inventory, and you had in accounting 201, which is beginning inventory plus purchases gives you goods available for sale. Once you've got your goods available for sale, you either sell them or you don't. And the ones that you take away, the ones that you did, you got the value ones that didn't. That's basically the idea. Okay, so let's go ahead and look at the first method, the gross profit method. And this is typically what a textbook will tell you, that the ABC company recently had a fire which destroyed all of their inventory records. However, the company has sales information and data from the past years and inventory data from past years. So they know that the beginning inventory for this year was 1,600,000. They know that purchases of inventory, because apparently they had those, were 500,000. They know that the sales for the period were 1.5 million, and then they know that their historical gross profit on sales is 30%. So you can already see the logic building. If you can compute the goods available for sale and then take out the cost of goods sold, that'll give you the ending inventory. So this is not all that complicated. Okay, so let's do this. So they're trying to estimate the inventory. Okay, so from past records, they know, because apparently, I guess the records burned at the end of the year. So they know their beginning inventory was 1.6 million. Okay, then they bought inventory worth 500,000. So their cost of goods sold, I'm going to put a little line here, was 2.1 million. Okay, now they don't know the cost of the inventory, but they know how much they sold, and they have an estimate based on history of what they know how much their revenue was, and they know based on historical experience what their gross profit is. So the historical sales or their sales, they know their sales were 1.5 million, and they know from history that their gross profit is generally 30%. So if you take out um, 30% of their sales here. So sales are 1.5 million is equal to, and we're going to take out the gross profit from the sales. So let's just take this times 0.3, and then we'll put a minus sign in front of it. Okay, so if you know that your total revenue was 1.5 million, and that of that revenue, gross profit was 450,000. The rest must be cost. So your estimated cost of goods sold is equal to your sales less the gross profit that you made on the sales, which would be, or that would be a plus, by the way. Got it to minus. So your estimated cost of goods sold is 1,050,000. So if you take just using the little logic of the inventory formula, you could have sold 2.1 million. You've estimated your cost of goods sold at 1,050,000. So that means that your estimated inventory, your estimated ending inventory is actually half of that, which is by coincidence, by the way, which is that minus that number, or we'll just put a negative in front of this here. So we'll do. So your rest. So going back toward the logic, going back over the logic, it's from the records they have the beginning inventory and the purchases. So they know that the goods available for sale are 2.1 million. They also know, and this would make sense because they have records, the transactions with outside customers. They know that their sales revenue is 1.5 million. They take out a historical gross profit of 450,000, so their estimated cost of goods sold is 1,050,000. And we go back to the logic. That's what you could have sold. That's what you did sell. So what you didn't sell is your ending inventory. It's just by coincidence, by the way, that it happens to be half in this particular example. So that's what you're estimating for. It's the old logic. This is what you could have sold. This is what you didn't sell, considering that your sales revenue is 1.5 and you have to take out the gross profit of 450,000. That's the cost of what you did sell. So this is what you could have sold. This is what you sold. So this is what you did not sell. It's basically just the logic of the cost of goods sold formula. Okay, so I'll put this video up and we'll go to the next method, which is a little more involved, but really not that much more.